Hello everyone, this is Dr. Shah once again with another video. In this video, we're going to solve November 2019 University question paper under the subject Investment and Portfolio Management. Again, a very important video for all the TYBMS SEM-V student. The subject is also known as IAPM in short. In this video, we're going to take up all the practical sums that had appeared in the paper. So let us see which were the sums that had appeared and how to solve them in the most simplest manner. Okay, chalo. The very first question that had appeared in November 2019 paper was calculation of beta of each of the following two companies with the help of the given information. Okay, now they had a typo error in the question paper. They mentioned about two companies, but they had only given for one company. Okay, so their years, Rudra Limited and market returns. So security returns are given and the market returns are given. So again, we first need to create a table. Okay, we'll have Rudra Limited, we'll have years 1, 2, 3, 4, 5. The return on security 19, 16, 13, 19, 23. The total comes to 90. And market return, that is 20, 17, 14, 20 and 24. Total comes to 95. The moment you all get the total, first step you need to find the average of both the returns. So RS bar is total of RS upon N, 90 upon 5, which comes to 18. Next is RM bar, total of RM upon 5, so 95 upon 5, which comes to 19. Once you all have got these two averages, the next column is RS minus RS bar. So all the values of RS minus RS bar. So 19 minus 18, 16 minus 18, 13 minus 18, 19 minus 18 and 23 minus 18. We get the respective values as 1, -2, -5, 1 and 5. Similarly, we need to find for RM. So in the next column will be RM minus RM bar. All the values of RM one by one minus it with RM bar. So 20 minus 19, 17 minus 19, 14 minus 19, 20 minus 19 and 24 minus 19. We get the values as 1, -2, -5, 1 and 5. Once you get the differences, multiply them in a third column. RS minus RS bar into RM minus RM bar. So it will be 1, 4, 25, 1 and 25. Last step, whatever was RM minus RM bar, square that and that put it in the last column. So 1 ka square is 1, -2 is 4, -5 is 25, 1 is 1, 5 is 25, total comes to 56. So the last two column ka totals are very important. Once this table is done, we start with the very first formula, that will be covariance. Covariance is nothing but the second last column divided by n minus 1, so that is 56 divided by 5 minus 1, so 56 divided by 4, we get the value as 14. Then we need to find the standard deviation square m, that will be last column divided by n minus 1. So 56 divided by 4, which comes to again 14. Last beta is equal to covariance upon standard deviation square n, 14 divided by 14, so the beta is 1. So therefore the beta of Rudra Limited is 1. Okay, so this is how you'll have to solve the very first question based on beta. Chalo, go through it once and then we'll jump to the next question that was there in the particular question paper. Okay, the next question that had appeared in the paper, the rate of return of stock M and V are given to us and calculate the expected return and standard deviation for both the stock. So we'll start with, they are giving you the period boom, normal recession, probability 0.3, 0.45 and 0.25. First we are going to take the return of M, that is 35, 55 and 70. So boom, normal, recession, the probabilities we have noted down and the returns. The next step is we need to multiply probability with the return. So 35 into 0.3, 55 into 0.45 and 70 into 0.25. We get the values as 10.5, 24.75 and 17.5. We total add up, we get 52.75. Therefore, the expected return is 52.75% for M Limited. Now the next column, we need to find R minus expected return. So all the values of R minus with 52.75, we get it as negative 17.75. 55 minus 52.75 is 2.25 and 70 minus 52.75 is 17.25. Next column will be, we need to find the square of whatever we just now found. So 17.75 negative ka square is 315.6. 2.25 ka is 5.06. 17.25 ka it is 297.56. Once we get the square, multiply that with the probability and we should get 94.52, 2.28 and 74.39. Total comes to 171.19. That is nothing but the total variance. Once you get the total variance, we can apply the standard deviation ka formula, which is the root of variance, that is root of 171.19, which comes to 13.8. So the expected return is 52.75 and the standard deviation is 13.08 of M Limited. Okay, same way we need to find for V Limited. So again, 3 period, boom, normal recession, the probabilities and the returns 70, 55 and 35. We multiply 70 into 0.3, 55 into 0.45 and 35 into 0.25. We get the values as 21, 24.75 and 8.75. Total comes to 54.5. So the expected return is 54.5%. The next column will be R minus ER. So 70 minus 54.5, 55 minus 54.5 and 35 minus 54.5. We get the values as 15.5, 0.5 and negative 19.5. Square them up. We need to square it up. So we get the values as 240.25, 0.25 and 380.25. Once you get the square, multiply that with the probability. We will get 72.075, 0.1125, 95.0625. We add up, we get the total amount as 167.25. The total is nothing but variance. Once you get the variance, standard deviation is the root of variance, root of 167.25, which is 12.93. So now if they tell you which one will you advise, so if you look carefully, expected return of V is much better and the standard deviation or the risk is much lower. So in both the cases, the V Limited is better, returns is a little higher and standard deviation is a little lower. So in this case, if they ask you which company will you advise, so the answer would be, we would advise to invest in stock V Limited. Okay, chalo, this is how you'll have to solve this particular sum. Go through it once and then we'll go and check the next sum. Okay, now the next question. Compare the following portfolio according to Jensen's measure of portfolio evaluation and rank them. Portfolio mein HDFC, Kotak, ICICI and market index have been given you. They given you the return, beta and risk free return. Now the first step, okay, Jensen measure mein expected return ka formula is, okay, first expected return ka formula is risk free return plus beta into RM minus RF. For HDFC, okay, the market return were 14, risk free return is 7, so 14 minus 7 into the beta, okay, risk free is 7 for here also. For all actually it is 7, so not an issue with that. So 14 minus 7 into 0.8, okay, plus the risk free return plus 7, so we get the value as 12.6. Same way for Kotak, it is 14 minus 7 into the beta, which is 1, plus 7 gives you 14%. And same way for ICICI, it is 14 minus 7 into beta, which is 1.5, plus 7, we get it as 17.5%. Now once we have got the values, okay, for all the portfolios, HDFC, Kotak and ICICI. Now we need to find the we have to, this is as per CAPM method. Okay, this formula is similar to CAPM. The only thing which distinguishes into Jensen is the next part. So Jensen differential measure is equal to the actual return minus the expected return. Actual were 15, 16 and 12. So we written here 15, 16, 12. The expected returns were 12.6, 14 and 17.5. So we subtract then 15 minus 12.6, 16 minus 14 and 12 minus 17.5. So in that case we got 2.4, 2 and negative 5.5 are returns. And so with that we need to just finally rank them. So the highest one was 2.4%, which was of HDFC. Second rank was 2, which was of Kotak. And third is a negative value of ICICI, so that will be rank 3. So first we need to find the expected return and then apply into the Jensen's formula. Whichever is the highest value, that will be rank 1, followed by the second and the third. Okay, so this is how you'll have to solve question number 3A based on Jensen's measure. Chalo, go through it once and then we'll move to the next sum. Okay, now chalo, we jump to the next sum. Question number 3B was calculate expected return and standard deviation. Again, similar to the previous to some earlier which we had done. SAM limited and CAM limited, returns are given, probabilities are given. So probability 0. First we are going to do for SAM 0.33, 0.33, 0.34, return 6, 30, 18. We multiply them 1.98, 9.9 and 6.12 we will get. We add up, we get it the total as 18%. That is nothing but the expected return, which is 18%. Now we need to subtract return with your expected return. So 6 minus 18, 30 minus 18, 18 minus 18, we get a negative 12, 12 and 0. Square them, 144, 144, 0. Multiply the square with the probability, we get it as 47.52, 47.52 and 0. Total comes to 95.04. That is the total variance. Standard deviation is the root of variance, root of 95.05. So we get the value as 9.75. Now this was for SAM limited. Same way we'll have to do for CAM limited also. So 0.33, 0.33, 0.34, the probability. Returns are 9, 12, 18. Multiply, we get 2.97, 3.96, 6.12. Add up, we get 13.05. Therefore expected return is 13.05%. Once you get the return, now once you get the expected return, we will just multiply now. We'll have to go to the next step now. That is return minus expected return. 9 minus 13.05. 12 minus 13.05 and 18 minus 13.05. We get the value as negative 4.05, negative 1.05 and 4.95. Square them up. Once you square it up, it will become 16.4025, 1.1025 and 24.5. Once you get the square multiplied with the probability, 5.41, 0.36, 8.33, the total comes to 14.1. Therefore, the standard deviation is nothing but the variance of 14.1, which comes to 3.75. And now if you have to, if they had to advise, so based on expected return, the first one is way better. But as per the risk, the second one is way better. Okay. So that would have been a conclusion if they would have asked. So you all can go through it once and then we'll jump to the next question. This was based on expected return and standard deviation. Question number 3B. Okay, the next question, question number 3C. The security return and beta factor, the four securities are given. So they're giving you returns and they're giving you the betas. The risk-free return is given. Okay, they're telling you to calculate the average market return and expected return for each of the security under CAPM method. So first we need to find the average market. Average market is nothing but sum of all the returns divided by the number of returns. So it will be 18 plus 10 plus 12 plus 15 divided by 4. So we get it at 13.75. That is the average market return. Okay, now we need to find the expected return for each of the securities. So for Modi Limited, risk-free return plus beta into RM minus RF, it will be 13.75 minus 7 into 1.6 plus 7, we get it as 17.8%. Next, for Gandhi, it would be again 13.75 minus 7 into 0.8 plus 7, which comes to 12.4%. Next for Mehta, it will be again 13.75 minus 7 into 1.2 plus 7, which comes to 15.1%. And last for Sardar, it would be 13.75 minus 7 into 1.5 plus 7, which comes to 17.125%. Okay, so this is how I'll have to solve the sum based on expected return as per CAPM method. So go through it once. Okay, the next question was question 3D. The detail of 3 portfolios are given below. Okay, compare these portfolio on performance of using sharpest and tenor measure. Risk-free return is 8%, average return, beta and standard deviations have been given to us. So first we note down the headers, measures, formula, Padma, Zarna, Minakshi and market index. The sharpest formula is return minus risk-free return upon standard deviation. So 18 minus 8 divided by 0.3, then 12 minus 8 divided by 0.35, 16 minus 8 divided by 0.5, 14 minus 8 divided by 0.25. We get the values at 33.33, 11.43, 20 and 24. Similarly for Trenor's measure, same, the numerator remains same, the only thing is the division will be by beta now. So 18 minus 8 divided by 1.4, 12 minus 8 divided by 0.9, 16 minus 8 divided by 1.1 and 14 minus 8 divided by 1. We get the values as 17.14, 4.44, 7.27 and 6. Okay, so this is how you'll have to solve question number 3D based on Sharpe and Trenor's measure. So go through it once. Okay, now the last question which was asked was Hero Limited has presented its financial information for the year ended. They given you EBIT, 2 lakh equity share, debenture, reserve, provision for tax, proposed dividend, and market price. They are asking you to first find earning per share. Now, earning per share ka formula is net profit after tax. Before tax is 16 lakhs. Okay, less preference dividend upon number of shares is 2 lakh. So since it is before tax, you minus the tax 30% from it. So when you minus 30% cut tax, we will get the value as 11,20,000 divided by 2 lakh, which comes to 5.6 rupees. Next is PE ratio. PE ratio is market price per share upon earning per share. Market price is 32. Earning per share is 5.6. Divide, we get the value as 5.71. Next, dividend payout formula is dividend per share upon earning per share into 100. Now, dividend was given as 20%. So 20% of equity because preference is not given. So 20 lakh ka 20% 4 lakh divided by 22 lakh number of shares. So the dividend per share comes to 2 rupees. So 2 upon 5.6 is into 100 is 35.7. Next, dividend yield is market dividend per share upon market price into 100. 2 upon 32 into 100, which comes to 6.25. And last, debt equity. So that is debt which was 3 lakhs, 30 lakhs. Equity is equity plus reserve. So that is 20 plus 10, 30. So 30 upon 30 is 1. So debt equity is ratio is 1. So this is how you all had to solve the sum based on ratio analysis. You all can go through it once. Chalo, with that, I hope everyone have understood all the various sums which had appeared in this paper. With that, we will be ending this video here. Thank you.